So let's talk about TFI International. You've probably seen their trucks on the highway, a big player in North American logistics. But if you're looking at it as an investment, it's something way more interesting. It's a highly disciplined, acquisition-driven growth machine. And today, we're going to break down exactly what that means.
Right off the bat, here's the core puzzle with TFI. On one hand, you have this long, successful history built on really smart acquisitions and tight operations. But on the other hand, the company's future is basically riding on one of the biggest, highest-stakes turnarounds in the industry today. So, which is it? That's the real tension we're going to unpack.
The first thing you have to get about TFI is that this isn't a company that just grew organically by buying more trucks. Nope. It was built piece by piece through one smart acquisition after another. At its heart, it's an M&A machine. And when I say machine, I'm not kidding. Just let this number sink in for a second. Over 140 acquisitions since 2008 alone. This isn't a side project for them. Buying and fixing other companies is their business model. And they've got it down to a science. It's a simple, repeatable playbook. Step 1, they find good transportation companies that are just underperforming. Step 2, they buy them at a price that starts adding to their own bottom line right away. And Step 3, they dive in, streamline everything, and squeeze more cash flow out of it. It's a disciplined process they've run again and again.
So, after all these acquisitions, what does this M&A machine actually own? Well, the company organizes everything into 4 distinct parts, what they call their 4 engines.
Let's run through them real quick. You've got package and courier, which is huge in Canada. Then there's less-than-truckload, or LTL, a really strategic and important part of the business. Truckload is kind of the bread and butter of the industry. And finally, logistics. This is their asset-light division, which is smart because it gives them flexibility without having to own a ton of expensive trucks. For an investor, this diversity is great. It means they're not totally dependent on just one corner of the economy.
Okay, now let's get to the main event, the single biggest piece of the TFI story right now. Back in 2021, TFI made this enormous $800 million bet. They bought UPS's freight division. Now, this move massively scaled up their US LTL business, but it came with a huge catch. They had to turn around a business that was, well, notoriously inefficient.
You can see it right on the timeline. 2021 was the big one, the deal for what's now called T-Force Freight. And yeah, they just made another big move in 2024 buying Dasik. But honestly, all eyes are still on that T-Force turnaround. Its success or failure is probably going to decide where the stock goes for the next few years.
So, is the plan working? Is the big bet paying off? Well, the data says a pretty clear yes. The key number here is the operating ratio, or OR. Basically, it measures expenses against revenue. In trucking, lower is always better. When TFI took over, T-Force had a terrible OR of almost 99%. Now, they've wrestled it down to 94%. That drop is real, tangible proof that the turnaround is taking hold.
But here's where it gets really exciting if you're an investor. While 94% is a huge improvement, it's still nowhere near the best in the industry. The top-tier guys are running below 80%. That massive gap between where TFI is now and where they could be, that represents hundreds of millions of dollars in potential profit if they keep closing it. That's the upside.
Okay, so with the turnaround in mind, let's zoom out and look at the scorecard. How does TFI stack up against its peers when you look at the numbers that really matter to investors?
This comparison is fascinating. Look at the forward PE ratio. That's just a fancy way of saying how expensive a stock is. TFI is trading way cheaper than its peers, and that's likely because the market is still a little skeptical about that T-Force turnaround. But now look at the free cash flow margin. This shows how much actual cold, hard cash the company generates. And here, TFI is just dramatically better. That disconnect, a cheap valuation on a cash-generating machine, is the core of the whole investment opportunity.
And that cash generation isn't just a percentage on a slide. We're talking about real money. In 2024, a year that was pretty weak for the freight market, TFI still generated nearly $770 million in free cash flow. That is a testament to their financial strength and discipline, even when times are tough.
So what do they do with all that cash? They have a very clear pecking order. Priority 1 is funding more smart acquisitions. They're always fueling up that M&A machine. Priority 2 is investing back into their own business. And priority 3 is returning capital to shareholders. This discipline lets them build up a serious war chest for their next big move.
Now, we've covered a lot of ground here. Acquisitions, operating segments, valuations. It can feel like a lot.
But what if I told you that you could track this entire complex investment story by watching just a single number?
I'm serious. The entire story, all the risk and all the reward, it's all captured by a single metric.
And that number is the operating ratio, or OR. We saw it earlier, and it's so important it's worth hitting again. It is the single best measure of efficiency in this business. For investors, the rule is as simple as it gets. You want to see this number go down.
So which OR matters most? It's the operating ratio of the U.S. LTL segment. That's the division that includes T-Force Freight. Every quarter, this one number will tell you if TFI's biggest gamble is paying off. If you see it continue to drop, the investment thesis is playing out exactly as planned.
Which brings us to our final thought. The turnaround is clearly showing signs of success. The company is generating mountains of cash, even in a down market. And they're building a war chest, true to their identity as master acquirers. So the question this leaves for any investor is a compelling one. What are they going to buy next?